My name is Jeff, and I former fund manager. I still do a lot with the markets. I primarily focus on trading, and how that affects things. I trade in a very different style than many that are out there. But before we get started, I'm going to talk about a concept that's a little bit not as trade related here today. But before we do that, I'm here on one of our algorithm trading sites, TM Signal, and this is just pure algorithm based. A, B, C, D, E happened, boom, here's the signal. Here's how the signal performed in the past, and it's based on closing prices each and every day. Today, one of our top performers triggered bullish, and that is NVIDIA. And NVIDIA over the last 2 years has had 19 signals. So this isn't something that happens very often. This isn't day trading or anything like that. It's had 19 signals. The average gain on the trade is 10%, base closing price to closing price. And there have been 11 winners, eight losers. Today, triggered bullish here today. I went and jumped into a little bit for whatever you want to take of that with NVIDIA, but one that has some of the elements that we see in this specific stock that lead it to go higher over the next several days to next several weeks. But anyway, that's NVIDIA. Now today, I want to go out and take a look with you at something that's not as trade related, but is much more investor related, much more related to what we're going to see coming up in the market over the next several weeks and several days even. The calendar is about to turn, and it's going to turn into the month of October. There's several myths and several facts about the month of October. Basically sell on Friday in October and you'll probably make money, has been a long-standing one. But this October of 2017 will mark the 30-year anniversary of the 1987 stock market crash. And I'm not saying the market's going to crash this October. In fact, I would totally bet against it. But as we go through the course of this month, there's going to be a lot of talk. There's going to be a lot of chatter about the 1987 crash. It'll inspire in both traders and investors alike a little bit of worry, a little bit of panic. That's the media's objective, right? Because then they get eyeballs there. There's going to be a lot of theories. There's going to be a lot of opinions about it and what to do about it. But whether you're a trader or an investor, okay, most have IRA, 401k, money that they are managing, for themselves that is meaningful, that if was taken away would seriously impact their life, their outlook on the future, and would change things in a material way. When you have money exposed to the market, a crash can obviously dampen things, can obviously hurt things in a big way. And so I want to go take a look at the 1987 crash. We'll take a look at a few other crashes as well. Talk about the nature of those crashes and how they impact us from a trade standpoint and from an investor standpoint over the course of the next 4 weeks and beyond. I'll give you a couple trade suggestions for this type of time period, and I'll show you exactly what I'm doing. In 1987, this is the newspaper headline from the New York Times. Stocks plunge 508 points, a drop of 22%, 604 million volume, nearly doubles record. If we had a headline like this today, it would be pretty shocking. Even in this day, 508 points on the Dow is not a big move, but on a percentage basis. But given how flat and how just non-volatile the market's been, that would be pretty huge. Okay, great. Catches a headline, but is this the whole story? And okay, great. We could see this the day after. We could talk about how to react to it, but how can we see this coming? Right? There's this myth, there's this concept, there's this idea that no one can see a flash coming or a crash coming. And in some cases, yeah, there's an argument there. But crashes have something in common. They all do. There's always a scenario in the market where a crash is much more probable. And so let's go take a look. We're going to go talk about the causes of the 1987 crash. We're going to take a look at the 2010 flash crash, which I was involved in as a fund manager. Pretty crazy day. Parallels and differences in today's market, and then talk about some protection trades if there is another crash, and more importantly, protection trades for a portfolio, for your nest egg out there. Bottom line, I want you to take these things from today. A crash can happen at any time, but they generally occur after some strong prior selling creates a sentiment shift. Okay, there's almost always a sentiment shift that happens ahead of a crash. We'll take a look at that. We'll take a look at how to see that. It's actually really simple. Reasons for a crash, they can vary, but generally they're macro in nature, right? Every crash has a micro cause. There's a trigger, but there's a macro element that comes into play that creates a sentiment shift. Today, globalization increases the number of variables that can lead to a market crash. In fact, today in time, there are more things that could potentially cause a crash than ever before. Even though some of the things from other crashes have been rectified, there are still more variables that could lead to a crash. Now, I don't say that to say, oh man, we're going to crash, but to say, hey, the risk is still out there. But the other benefit that's out there, especially for investors and traders today, is that portfolio protection is cheap, it's easy, and you don't really have to pay attention to it. It's something you can really just go in, set once in a while, and not really have to worry about it from a day-to-day, minute-to-minute type of basis. Here's a simple chart, 1987. 1987, stock market had been on a 5-year bullish run, and the year started off pretty well. And here we come in July and in August, hit some highs in August, and market didn't crash from these highs, did it? What happened? Well, market had a normalized pullback. 335 down to 300, about 7% pullback. Very normal type correction in the market. We saw a little buying come into play, another little dip. All right, a little more buying, and then all right, we start to fall, right? We start to fall and we start to push into lows that are a little bit different, okay? That are a little bit different. In fact, by the time the crash happened, right, in 1987, by the time we had this big gap down, the market had already been more than 10% off of its highs. It had already sold off in a serious material way before the crash. And in fact, the crash happened, and if you're having to sell on the crash day, it doesn't feel too good, right? If you're not protected until the crash day, that doesn't feel too good. You've already put up with a real material loss, but you can see how that accelerates. Okay, that's a very normal condition for a crash in almost every crash that we go and look at over history. Take a look at 2010. This is the flash crash. Nowhere near the same in terms of magnitude as the 1987 crash, but a similar element in terms of what happened and what went on. Right? Market had been up and nice and great and grand and wonderful. It bottomed in February, starts going up in March, April, and then we start to see this breaking down. Right? This one happened a little bit quicker. Right, the market had gone about 5% lower before the actual flash crash, but the market was nowhere near its highs. Okay, it was nowhere near its highs by the time the flash crash happened. In fact, in this chart, we can see this candle or this price action right here shows the flash crash. But if we actually take the flash crash and what it meant and what the price action was, the market on this day was already down pretty good. Right, in fact. I was fund managing at the time. We were short going into this day, net short. We had taken off before the flash crash. We had taken off most of our short exposure. We had hit limits and hit areas where, some of our profit targets were hit and the risk rewards just didn't make a lot of sense here. And we took a lot of it off. And, as we're kind of watching things, looking at kind of what do we want to do from here, all of a sudden we start to see the market tumble. and just starts to tumble, tumble, tumble. And then into the close, it bounces all the way back, right? I mean, not all the way, but bounces back in a big way. So, the flash crash really only led to, a little bit of loss on that day, nothing like on 1987. But that same element, that there was weakness ahead of the crash. Now, if we come in and take a look, one of the things we need to understand are some of the causes of any type of crash. If we're going to be able to position ourselves, if we're going to be able to protect ourselves, we really need to know what is creating that environment, and is that environment likely to be had now, or is that environment something that maybe we need to see a little bit more action going on, a little bit more change actually happening here in the market. And it looks like I lost my slides here. Bear with me 1 second. There we go. All right, sorry about that. But let's take a look at the causes of the 1987 crash. Now, if you go and you do your research, you do your homework, there's going to be a lot of reasons for the crash. Different people will write different things. Different people will say different things about it. But these are some of the reasons that are talked about. Stocks are overvalued, right? This is a really popular thing for the bears to talk about. It's been popular in our market today. Stocks are overvalued. All right, we'll go take a look at it. Computer trading, right? What's the effect of computers here? Okay, what's going on with that? Okay, what are fund managers doing, right? In 1987, fund managers were forced to be buying, right? What was the impact of that? How did that play into the crash? Sentiment shift. I've kind of already given it away, but bottom line, ahead of any crash, there's a sentiment shift. Rising inflation was one of the things that is blamed on the 1987 crash, and then falling GDP. Okay, falling GDP. So some economic variables, some overhead variables here, all kind of leading to this 1987 crash. So let's break them down. Let's go to overvalued. This is one that in our trading community, I find that I fight a lot in terms of this argument that stocks are overvalued, right? Stocks like NVIDIA, right, that we looked at just a moment ago, NVIDIA has been overvalued since it was 30, right? It's now trading up around 180 bucks. So it's overvalued and it keeps going up, right? To take a look at general market valuations, there's a few ways that we can do it, all right? I'm going to come in here and take a look at a Shiller PE, and it's a website called multiple.com. And Shiller here, Yale economist, very famous for his work. He does some great work in terms of valuations and everything else here. But here on this site, he has it noted and published what the PE ratios in the market have been over time. Now, a PE ratio is a very simple valuation measure that is simply based on the price of the stock divided by its earnings per share. Okay, that's it. Price divided by earnings. Very basic, very rudimentary measure, and a measure that has had a lot of value over time, but over the last 20 years has lost a lot of its effectiveness in terms of any types of predictability. But let's go take a look at it, okay? Let's go take a look at it. Black Monday, 1987. In fact, they have it labeled right here. Black Monday, the Shiller PE was around 17 or 18. Now, the actual PE ratio of the market right then was really around 20. Okay, but what's the sentiment going into it? Yeah, stocks have been more highly valued in the 1960s, but in 1980, the PE was here under 10, below 10. So by the time we go to 1981, 1982, 1983, 1984, right? What's been going on to the PE ratio? Well, the valuation of the market has been getting more and more expensive, higher and higher. So by the time Black Monday came, what was the perception of valuation, right? They had no idea the valuations were going to skyrocket in the 90s. Okay, they had no idea. What was the perception at that time? Well, the perception was that stocks were expensive. That was the perception. Now, I wasn't trading at the time, but that was the overlying perception. Did that keep fund managers away? Did that keep people out of the market? No, it didn't. But that perception was that things were overvalued. Fast forward to today. Where are we at today? Well, we're at 30.8, right? We're significantly more expensive than we were on Black Monday. All right. Does that mean anything? Does that mean we're going to crash, or does that mean we're going to be like the tech boom, right? Where we come up and get even more overvalued. Black Tuesday, 1929 crash, valuations were about what they are today. What does it mean? Well, for me, okay, for me, it's worthless, okay? Yes, fund managers know that the market is overvalued from a PE ratio basis, but they use other valuations to justify getting in. Back in the 1980s, when you don't have as much information, right? We haven't gone through the information age. Information isn't available at the, at your fingertips. You don't get tweets, breaking tweets, whenever the U.S. president says something or whenever a corporate CEO says something, right? Nowadays, we have all that. It's instant information. It wasn't the case back in 1987. So there was a greater risk factor. Now there's an easier way to react, quicker way to react. What was also very different? Well, back here in the 1980s, bond rates, right? If I'm an investor, I can walk into the bank, I can give them my money and say, hey, I want a CD, pay me 8%, a year. If you walk into your bank today and ask for 8% a year, they're going to laugh you out the door. So there's not the same alternatives that there were back then. So investors are kind of forced in. That's the story when it comes to PE. Right? We look at different causes and different, elements of the 1987 crash. And overvalued really isn't a factor. What is a factor is that it forces fund managers into the market. You say, well, how come? Well, fund managers, they're measured not by their performance every year, right? If I'm a fund manager, which I have been and, been through all of this, I'm a fund manager. And I send out to my clients at the end of the year, hey, congratulations, you made 20% on your money over the course of 2017. How are my clients going to react? Are they going to be excited? Are they going to be mad? You would think, oh, 20%, well, great. Well, if the market is up 50% that year, what are most of my customers going to do? What are most of my clients going to do? They're going to take their money. They're going to walk out the door. They're going to say, no, thank you. I'm going to go somewhere else. I can do it better myself. If the market is flat on the year and I'm up 20%, what's going to happen? Your customers are going to say, hey, how can I give you more money? Hey, I got this buddy over here. Can he join in, right? You're going to see money inflows flock to your fund. Well, wait. You made 20% in both scenarios. One scenario, the market was up big. One scenario, the market was flat. Fund managers cannot underperform the market. That's when their jobs are at risk. There's no real job risk as long as they're outperforming the market. Meaning if the market's down 20% and they're down 10%, no big deal, right? They're outperforming the market. That's just kind of how the system works, right or wrong, whatever you want to make of it. But what's going on? What happened in 1987? Well, the market's bull market. Fund managers, what do they have to do? Can a fund manager sit on the sideline and say, nope, I'm not buying this market. It's overvalued. No, they can't, right? What are they going to do? Go buy some bonds, right? They can't do that. They can't sit on the sideline. They have to keep up at least with market performance. How are you going to keep up with market performance? Well, you at least have to be in, and you have to keep getting in. You get a little bit behind, you have to keep putting more money in. You have to start leveraging up. Well, take a look at what's been going on the last several years in the U.S. markets. A lot of fund managers have been lagging the markets, been underperforming the markets. What are they having to do? They're having to leverage up. They're having to get in. They can't sit on the sidelines. Even though valuations are expensive, they can't be on the sidelines, right? They just can't. But what are they going to do? You're a fund manager. You don't want to be in, but you're forced to be in. What are you going to do the second something nervy starts to happen? What are you going to do if sentiment starts to shift or if you start seeing some bigger warning signs? If the market starts to drop, are you going to be patient and wait it out? No, you're not going to be patient and wait that out. You're going to sell, sell, sell as fast as you can. When valuations are down here in the 10 area, PEs are cheap, or you're a fund manager and you have what you believe is a really cheap stock, are you going to wait it out? You going to have any issue with waiting that out? Not at all. We have a case going on with that right now in the market. It's General Motors. General Motors is one of those stocks right now where investors, it's cheap enough that investors are not panicking anytime there's bad news. And anytime there's good news, we see money jump into it. And it's still that way. It's still that cheap. Yeah, it could have a little pullback here and there, sure. But even on this day right here, we see General Motors drop, right? Bad car data, beginning of the month, August, car data, but no follow through to the sell. Why? It was bad news. Well, investors aren't jumping off. This is a trader thing. This is a few investors, but in general, investors have been buying and they've been buying, and they're not buying because they expect this one piece of data to be great. They're buying saying, you know what? I'm buying a stock that's cheap enough that I can let it turn around for several years. Yeah, so what? It goes to 32. Fine. My valuation is still good. I'll buy some more there. Are they doing that with a stock that has a fuller valuation? Are they doing that with a General Electric whose valuations are nowhere near as compelling? No, they can't wait it out. Why? Because the downside risk is even greater. Well, fund managers are in that situation right now. Where are they buying into a market that's cheap that they can just wait it out? Or is it like 1987 where, look, the market's relatively expensive, there's not as much value in it, so okay, something negative happens, they've got to run. Well, we're in a very similar situation in 1987 today in terms of those fund managers, okay? Now, again, I'm not saying we're going to crash or anything like that, but we're in a very similar situation that we'll have to be mindful of. What about the economic situation? What was going on economically? Well, economically in 1987, we were dealing with GDP rates starting to tick a little bit lower. Now, GDP was up around 5%, and today we'd kill for that, but it was starting to tick a little bit lower. Inflation was on the rise. There were some economic concerns that were starting to come in. But nothing different than in 1986, nothing different than in 1985, nothing really even different than 1984. The inflation went hand in hand with growth, right? Went just right alongside with those. And so we have this environment where 1987 valuation stretched, economics starting to get stretched and starting to show a few downward signs. But is that really any different than 90 other periods of time, than other years out there? It's not. And so if we're going to be talking about a crash, very rarely does it have to do with valuation. Very rarely does it have to do with economics. Very rarely does it have to do with fund managers and whether they're in or not. What it has to do with is sentiment shifts. All of those factors, valuations, economics, earnings, they can all kind of play into sentiment. But the biggest thing that drives a sentiment shift is price action. And it is one of the reasons, and the biggest reason, why we see, and let me back up here, any and every crash be followed by or preceded by a strong sell-off in the market. Okay? Very rarely, if ever, and I can't find a case, maybe one of you can go find a case in 1910 or something, do we see the market hit a new high and then crash. We'll see it hit a new high, pull back 10% over time, then crash. But even on that same week, market hits a new high, does it crash? Almost never. And I say almost never because, well, there may be a situation with the stock market in London in 1820. Great. I haven't done that research. But as far as U.S. markets go, no. There's always some sort of pullback. And what does this pullback do? Well, it takes this time period, right? Were there concerns about economics up here? Were there concerns about valuations right here in September? Yeah, there were. Were they leading to all the selling? No, they weren't. What led to the selling? Well, there was a sentiment shift, okay? There was a sentiment shift and there was a trigger. And the biggest thing that creates the sentiment shift is price action. Now, any crash needs a trigger, okay? Let's take a look at the logistics of a crash. Number one, money manager sells. Okay, all right, great. 2010, flash crash. This is how it happened. Money manager wakes up in the morning, looking at the market, looking over their portfolio, goes in and says, I want to sell some S&P futures contracts, okay? They're going out and selling them. Now, they're not selling them because they're bearish or they're betting on the downside of the market. They're selling them to hedge. They have a portfolio of upside stocks. They need to hedge it. So they're not going in saying, oh man, this market's going to crash. Let me just go and sell these things. But they come in with a large quantity. This money manager comes in with a large quantity, sells it to hedge. All right, great. Nothing unusual, nothing abnormal. But what happens? High frequency traders, HFT traders, join in. Now, what are high frequency traders? High frequency traders are computers, okay? And they step in and they buy up what is being sold. But high frequency traders do not want to buy and hold. What do they want to do? They want to dump it real fast. Well, okay, fine. So other high frequency traders join in. They're buying what these high frequency traders are selling. And we start to see this increase in volume and money passing back and forth between these high frequency traders. But what happens? These high frequency traders, eventually there's no one else to sell to. Right? They've bought up these contracts. There's no one else to sell to and make a profit. So they're holding all of these contracts that they want to dump, that they want to sell as fast as possible. But the price action is pushed down to a point where stops are triggered. So what happens? That puts more pressure in. That puts more sell side pressure in. So high frequency traders will look and say, man, there's no one to buy up my stock anymore. They're turning off. Their algorithms are turning off all their buy. And now what happens? You're left with a market that's completely weighted on the downside, where all these sell orders are there and all the computers have turned off their buy orders. This is what happened in 1987. The computers just turn off the buy orders. The stops get triggered. So what happens? We go from this selling to hedge to this increase of volume to now no liquidity. You have all this stuff wanting to sell, no one wanting to buy, right? And now what has to happen? Now the prices have to drop significantly to get anything to come in and buy. The computer programs are saying, no, we'll buy 10 points lower, but we're not buying right here, right? The algorithms are such that they automatically do all of this. But this isn't Joe in Florida sitting there and saying, market's selling off a little bit. Let me go out and sell my positions. No, it's happening too fast, okay? But there's an element of computers here. There's an element of liquidity. There's an element of a fund manager here. Now you go and take a look at the CFTC and what their conclusions are. They're all over the board. There was one person who was brought up on federal charges, with this whole scenario. But the bottom line is this sparks by an event. Can this happen? Can this happen at any time? It sure can. But most crashes have a similar type of logistical approach here. In 1987, it was a little bit different. There weren't the high frequency traders, but computers were fairly new, right? Computers were fairly new. And fund managers would buy. They would go out and buy into the market, buy, invest, and great, they have to be in. We talked about that. And then they would set their computers and set their stops and say, you know what? Hey, I'm comfortable buying. I can't lose more than what's already there, and my stop's going to get me out, right? So fund managers are all sitting there comfortable. Their computers are buying on dips, but their computers also turn off when certain conditions are applied. And this is what happened here in 1987. The computers turned off. The computers stopped buying, so the liquidity went away. There's not a sell at 275, right? There's not a sell at 270. There's not a sell at 265. There's not a sell at 260. There's a gap, right? There is a gap. One morning, or one day, it's worth 280. Next morning, they're only willing to pay 225. It didn't take order fills the whole way down to get there, right? The computers were turned off. Every crash happens a little bit differently in terms of the logistics. But the logistics of a crash, okay, while this flash crash logistics, the 1987 logistics, while many claim to say, hey, these are fixed, right? The curbs are in, right? You hear that word, the curbs, they went and put curbs in so that if something falls at a certain degree, it's halted so that, liquidity can come back. Great. Right, they can go and they can solve the logistics of a crash, but what can't they solve? They can't solve sentiment changes. And when we look at a market and we look at today's environment, is the economic situation any different from other environments? It's different than 2010. It's slightly different from 1987. It's different from 1929. Economic environments are always different. The economic environment out there right now continues to grow. It's like a Ferrari going 5 miles an hour. It's growing and it's accelerating to 6 miles an hour, but it's a Ferrari going 5 miles an hour, right? Great. All right, it's growing. Markets keep going up. Valuations, we looked at those. They're stretched. All right, fine. Whatever. They've been stretched now for years. Money managers, are they forced to be in? Yep, same thing. Electronics, do we have all those? Absolutely. But one thing that we have not had in the past, little bit in 2010, but much more today than we ever have, is globalization. In 1987, if the markets woke up in Chinese markets were down 5%, 10%, yawn, snooze, nobody cares. In 2017, China down 10% overnight. What does that mean for U.S. equities? They're going to drop, and they're going to drop big. I'm not saying let's worry about China, but what I'm saying is India, it matters a lot more than it used to. What happens in Germany matters a lot more than it used to. What happened in Germany used to affect Germany. Now what happens in Germany affects Australia, Japan, China, India, US. There's this globalization element. What does that mean? That means that the New York Stock Exchange can have all the curves they want in. But if something happens in another part of the world, so there are a lot more variables. The risk of a crash, significantly higher than ever before. There are many more variables. And what is that trigger? What is that element, that comes into play? We're never going to know until it's all done. But what do we know? By looking at the history of crashes, we do know that ahead of a crash, there's a sentiment shift. Are we seeing one right now? No, we can look and say, oh, market hit a new high. Okay, you know what? It's never going higher, sure. But are we going to wake up tomorrow and the market's going to be down 20%? We could. It's the market. Market can do anything. But what are the chances of that? Extremely slim. When we have a market that's down 10%, what's the chances of some sort of crash? Well, significantly elevated compared to when the markets are hitting a new high. So what do? What do we do about this? Well, we need protection. Now, crash protection is cheap. And I'm speaking from a portfolio, not a trader standpoint, but from a portfolio standpoint. One thing about protection is I don't want to pay a lot. Everyone talks about protection out there in the market like it's this great, grand, and wonderful thing, but it's like car insurance. I've never been, knock on wood, never been in an accident. But every year I've had to pay my car insurance. My net, I'm down big, right? Have they ever stepped in and bought me a new car? No. They ever stepped in and paid my medical bills? No. They ever stepped in and paid somebody else's medical bills? Never. I'm down big. What if I have a portfolio and I'm buying insurance, I'm buying puts, I'm buying protection, however you want to buy protection, and I'm paying that protection month after month after month, but yet a crash never happens. What's happened to my portfolio performance? I'm getting hammered. I'm getting killed. It's not a position that I want to be in. So what do I want to do? Well, I want to look at two types of protection. Now, if you want to use general rule of thumb, buy portfolio protection for a crash, okay, crash protection, which I'm not talking about, individual stock. I'm just talking about crash protection after the market's down 10%. The odds of that paying off, the odds of something happening there are significantly greater than happened today. Can you buy it today? Sure. But chances are you're just going to be burning through cash. You're just going to be paying cash. So if you want a general rule of thumb, 10%. Now, as a fund manager, and still today, I use something that we dub the market vibe. It's an algorithm that tells us, okay, when are the odds higher that a crash occurs? When are the odds higher that a rally occurs? And each and every day, it gives us a bull signal, a bear signal, or a neutral signal. And when it goes bearish, I buy crash protection. How do I do it? Well, I go out and I take a look, and I come into, let me come in here. I come into the SPY, highly liquid, okay, extremely liquid, meaning I can buy and sell, with ease here. But I come in and I say, all right, I need to protect my portfolio. Let me go buy some puts. Same thing as buying insurance. Same thing as buying insurance. You're going to pay a premium, and if you get into an accident, right? If your car gets totaled, they're going to step in and make it whole. Well, you can purchase the amount of insurance that you want. Do you want a little? Do you want a lot? How much protection do you want? Do you have a $30,000 car and want to protect $10,000 of it? Do you want, to cover how much do you want them to cover? The more coverage you get, the more expensive it's going to be. The less coverage you get, the cheaper it's going to be. Well, in this case, I want cheap. We've already talked about it. I want cheap. Okay, I don't want expensive. I want cheap here. So I'm going to come down and I'm going to look and say, you know what? When we see a crash, many cases we're talking about over 20%. All right, in this market, what's 20%? S&P is at 250, so 20%, that's 50 points lower. Okay, that's down here at 200. So I can come in here to November and I can buy a put at 200 and pay 9 cents. All right, great. Still, I don't really want to do that. That's pretty expensive. 9% basically is what I'm paying for that protection. But I can come up and say, you know what? Let me do something like this. Let me get as close or the best price of insurance that I can get. Let's say 220. Let me pay 23 cents for this. Okay, let me pay 23 cents for this. And now let me turn around and let me sell some insurance. So I'll pay 23 cents to get covered at 220, and then I will sell somebody insurance at 218 for 20 cents. So I'm going to pay 23 cents. I'm going to receive 20 cents. My net debit, my net cost is 3 cents. What does that mean? Well, that means I have the right to buy the SPY at 220 and the obligation to sell it, or excuse me, the right to sell it at 220 and the obligation to buy it at 218. What does that mean if the market goes down? I know if you're not an option trader, I'm going a little fast on this, but what does that essentially mean? That essentially means that your 3 cents could be worth $2 if the market goes below 218. A little bit of return on your money. 3 cents to $2. Yeah. Naturally, do I want my 3 cents to go to $2? No, because that means my portfolio is getting hit, right? That means my Apple and my other stocks are getting hit. I don't want to be in that situation. But at the same time, if we have a crash, am I glad I paid this 3 cents? Is that covering me in a big way? Depending on how many contracts I do, depends on how much coverage I have. If I'm paying 20 cents every month, is that really eating into my profits? In a huge way. If I'm paying 2 to 3 cents a month, eating into my profits, a little bit, but not nearly as much, and it's much more palatable there. So out of the money put spreads on the SPY can be incredibly effective at hedging a portfolio after when we're looking at some heavy crash risk. I don't own a put spread right now. Okay, I don't own it. Why? Because the odds of a market crash tomorrow are almost zero. Okay. Market starts to sell off, sentiment starts to shift. I start to get a bear signal, or market's down 10%, either one, whichever one you want to use. Yeah, I'm paying this every time, 3 cents a month. Okay, great. I'm doing that. It's a small percentage, but it pays big time. You can also do this with the VIX. The VIX is known as the fear index, but you can come in and do this on the upside. What's the advantage to doing it with something like the VIX? Okay, and assuming you're familiar with the VIX, you may or may not be, but the SPY, it's going to have a certain amount that it goes down. The VIX, theoretically, it can go up indefinitely. In fact, in some cases, we've seen the VIX up here at 50, 60, 70. So if I come in here and I spend $1 for the 15 VIX on a call, and I wake up and tomorrow the market's crashed, and the VIX is trading at 40, my dollar is going to be worth 35. I have a huge return on my money, but I don't want to pay much, right? I don't want to pay much, and I want to be paying it in the right scenario. Looking at the clock, I'm running out of time to talk about some of those scenarios, but bottom line, a crash can happen at any time, but they generally occur after some strong selling creates a sentiment shift. The reasons for a crash can vary, generally macro in nature, generally sentiment driven, and I'm not talking about the media sentiment. I'm talking about fund manager sentiment. And how do you see fund manager sentiment? You just look at the markets going up or down. It's the easiest way. Globalization means there are more variables that can lead to a market crash today than there ever have been, and the portfolio protection is cheap, and it's very, very easy. Now I use something called a market vibe to determine when I should buy protection and when I shouldn't. And since we made this indicator public in 2015, it has had a bullish signal 261 days, a neutral signal 168 days, and a bearish signal 83 days since 2015. You can see the average gain on the bullish days is significantly greater than than the performance on the bearish days. This is a predictor. This is not a hindsight indicator. This is a predictor of what is most likely to happen. And the market vibe will go from bullish to neutral to bearish and shift every once in a while. It's only had 4 bearish days all year this year, right? Only 4, but it's had a heck of a lot of neutral days. We can see the majority of the gains in the market today have come after the market vibe is triggered bullish. Am I buying crash protection on the bullish days? No way. Am I buying crash protection after this signal's bearish? You betcha. You betcha. This is a simple algorithm, has nothing to do with the media, has nothing to do with anything else, has everything to do with price action, has everything to do with fund manager involvement and the risk of some sort of downside elements happening. I showed you earlier NVIDIA and how that is triggering bullish in terms of a specific stock. But if you're looking at portfolio protection, I say you can use that 10% mark. This is gonna give you a lot more. This is gonna give you a lot more in-depth look and much more of a, hey, do I need to set something today? No. Okay. Do I need to set something today? No. All right, great. Next, do I need to set something today? Yes. Okay, great. Easy enough, and you're not buying protection very, very often. If you'd like some more information on how these algorithms work, how they're used, and want to be able to build your own algorithm to be able to understand, okay, when do you want different trades? When do you want crash protection? And when do you want to really just sort out what the media and everything else is doing? Feel free to come here to TM Signals classes. We are starting next Saturday a course on algorithms. And in this course, we will dive through the algorithms that are used here at TM Signals for portfolio crash protection, as well as for individual trade signals. All the algorithms are based on closing prices, so they're very easy, very simple to use, but we'll show you how to build your own. we'll show you how to use these various algorithms. But you can see the course topics, the course outline here, where we'll look at the various technical indicators, MACDs, oscillators, trading volumes, but exits, entries, and how to fine-tune an algorithm. One thing about a trade plan, one thing about a trade concept, they change as the market changes. Through these various algorithms, we can see how that's evolving and find something that works no matter what the market itself is doing. The base algorithm that we're going to use is called the Trend Rider. It's had 41 open and closed trades so far this year, average gain of over 5% on those trades, and all using closing prices. So very, very simple. Anybody can use algorithms, no fancy math, trade skills needed. We need to understand what the big picture is and then find what is going on and where the numbers are working. Be able to look back and say, okay, what's been working over the last 3, last 6, last 9 months? And through this course, we will go out and look at that. I wish you great success trading, investing. For most of us, it's a passion. For some of us, it's it's an obligation. But regardless, it should be easy. It shouldn't be very difficult. And I wish you great success.